Just as a brief introduction, I'm Bob Hubbard with LBA Realty. I run our local office here in Arizona, also chair of NAIOP this year. We recently acquired a majority of the Esplanade project December 21st of last year, so we now own towers 1 and 2 here in the center, and then 4 and 5 here on this east end, including this conference center and all the retail. So conference center just got finished about a month ago, still doing some kind of trial runs, but it's been pretty well received. For those of you who look at the project with tenants or have stuff that you want to do yourselves, it's available. It's turned out to be a pretty cool facility, something we're excited to be using for NAIOP. And just anything else, you guys, not a sales pitch really on it, but if you do have stuff you want to do, it's here. We can do kind of social events, parties. It's actually working out pretty well and been a pretty cool amenity. So thank you, number one, for being here. I just want to do a quick introduction of Mark Stapp. Mark's been in the real estate business over 30 years. Runs the MRED program at ASU. He's a professor there. He's been extremely good to NAIOP. We did this this financial analysis and overview program with our mentorship program earlier this year. It was extremely well received. He did a phenomenal job, and we couldn't really be more grateful for what he's actually put together with some tangible materials and I think some great information. So without much else, just thank you to Mark, and thanks everybody for showing up.
Thank you, Bob. So first thing, I want to acknowledge the fact that Tom just walked in just in time to shuck his duties of introducing me, but he still made it. So thank you. I mean, it's actually very, very humbling to be here, and I appreciate NAIOP's asking me to do this. All of you are professionals in this business. So it's a little frightening to stand up here and talk to you all about something you deal with every day. What I hope to be able to do is impart maybe a little bit of different perspective on this thing we call financial analysis, and to be able to give you maybe a perspective that helps you think about how you analyze properties, analyze opportunities in the future. So when I was asked to do this for the emerging leaders, I had a couple of objectives that I wanted to try and get accomplished, and I had been coordinating with Crystal and Tom and other folks to set this up. First was have a general discussion about financial analysis. So operative word here is discussion. And I hope that I have whoever has a question raising their hand, shouting something out, throwing something at me, whatever you need to do to add something to the dialogue if you want to. If you disagree, if you've got some thoughts on it, if you've got examples, whatever it is, right? So my preference would be to have a dialogue as opposed to me just talking to you if possible. The second thing was to establish an understanding of this term that we use called value. And I'll talk more about that in a minute. Third is I wanted to establish a basis for financial analysis. And again, I'm going to tell you what I mean by that in a second, but that sets us up for an understanding of the tools that we use for financial analysis. And then finally, a discussion about the metrics that we use, the measures, what I call measures of merit, that are used for evaluating opportunities, right? So today is really about a broad discussion. And I believe it's necessary to have this broad discussion in order to be able to have a common framework for discussing the subject matter in more detail and being able to then talk about what analysis really is. So today's the broad subject. I'm scheduled to come back on May 18th, and we'll talk more detail about the use of financial measures, what they are, how we use them, how we misuse them, right? And how they get misapplied a lot of times. So first, I want to give you some perspective about why I talk about the subject matter the way I do. If you knew me when I was in 3rd grade, you would never, ever suspect that 1, I would have graduated from college, 2, right, that I could hold a professional job, 3, I'd be teaching people stuff, right? And 4, that I have the education that I do. I was severely dyslexic. like really severely dyslexic, to the point where they told my mother that I was mentally handicapped. And the reason for that was I wrote everything perfectly backwards. So the only way you could read anything that I wrote was to hold it in front of you and stand in front of the mirror, and then she could read it. And it all made sense. But what that did to me was it made it very difficult for me to read and for me to understand numbers. To this day, you'll recite a number to me, and I'll turn around and go write it down, and I'll forget it, and I'll have to look back at you, right? Because it's still a little bit of a problem for me. So how did I get to where I am? One, my ability to do this, and I'm really pretty proficient at it and have been doing it for a long time. But to do that, I had to think about this in a different way. Well, my ability to think about this in a different way and my need to think about it in a different way was also how I came up with how you teach this to a disparate group of people that come together in what we call the MRED program at ASU, from different backgrounds, different skill sets, different levels of expertise, different perspectives. And in 9 months, make them all very proficient at financial analysis. So I'm going to share with you the beginning of the basis for how I get that done in the conversation that we have around the subject matter, because it's not as straightforward as simply inputting numbers into Argus. So I start by talking about the fact that we communicate 5 different ways. We communicate narratively, right? We write stuff down, we read it, we write reports, right? We write prospectus, we write offering memorandums, we write all those kinds of things. We communicate verbally. We take that same information, we communicate it to people if you're in the brokerage industry, if you're marketing properties, you're talking to prospective tenants or buyers or investors. If you're trying to raise money, you're talking to investors, you're talking to bankers, et cetera. And it's got to relate to what you've written down. We communicate graphically, right? We use site plans, we use renderings, we use different tools like that. We communicate physically, body language, me talking to you, things of that nature. And we communicate numerically. So the thing that I try to get across to my students is the fact that all of these have to be exactly the same. They have to say the exact same thing. You can't say something narratively and not have it match numerically. You can't have something graphically not match the numbers or not match what you're saying or what is in your graphic. So we've got to be able to communicate. And this gets me to the number part. So a lot of people are scared to death of numbers. I get students in a program, and now this is a mid-career level program, but I'll get architects, I'll get people from marketing backgrounds, from advertising backgrounds that aren't used to using financial analysis, aren't really proficient at Excel or things of that nature, right? And they're scared of the numbers. Literally, they're like, yeah, you know, I don't know. They freeze up. It's like they heard the joke when they were a kid. Why is 5 afraid of 6? Because 6, no, was it, why is 6 afraid of 7? Because 7, 8, 9, right? So they think numbers are scary and they're going to hurt them. So I've got to get them to understand what numbers really do. And I saw this saying a long time ago by Galileo, that math is a language, right? So I use this as the basis for developing a methodology to talk to students. So to communicate, we need to have a common language, right? We have to have something that we all can relate to, that we all understand. So what I tell students that numbers tell a story. And I get them to start thinking about numbers not as a thing in itself, but as part of a bigger process, right? That is allowing you to communicate. And it's communicating along with those other ways that we communicate. But the numbers have to be able to tell the exact same story that all of the other pieces we communicate with are telling. So they tell the story of value in this business. That's essentially what we're doing when we're creating some analysis, whether it be due diligence, whether it's analyzing an opportunity, whether it's making a projection. What we're really trying to do is use those numbers to tell the story of the value, real, potential, whatever it might be. So in order to do that, and to be able to communicate with each other, we need to have a common language of numbers to communicate with. Okay? And that means we have to have definition of words, definition of terms that we use when we're talking about numbers. We know the numbers, 1, 2, 3, 4, 10, 20, whatever, right? But we use words when we're talking about financial analysis, and that requires us to have a common understanding of those two. So I start by talking about and asking the question, what is value? If what we're trying to do is tell the story of value with numbers, we have to ask the question, what is value to begin with? So value is a matter of perspective, right? It's a relative measure of something. And it's a way of quantifying utility. So what's utility? Anybody know what utility is?
Usefulness.
Usefulness, right? So economists will tell you utility has to do with the ability of something to, in its efficiency, to achieve some particular outcome. So what we're really trying to do with these numbers is to use them to quantify utility, the utility function of real estate. But many times when we do this, and going back to this other aspect of value, which is it's a matter of perspective, is we forget what gives something value, and it's that somebody else wants it. It really doesn't matter what we think, okay? It's what somebody else thinks, right? Because value is a matter of perspective, right? From the perspective of another person who's considering the utility of whatever it is you have, whether it be a tenant who's looking at occupying space, whether it's an investor who's thinking about purchasing a property for a particular gain, right? Whether it's someone analyzing a vacant parcel of land to determine what its capacity is and what its usefulness would be. It's from other people's perspectives. So we're used to a term called value proposition in business. Value proposition is a definition of a problem, right? And the ability of the product or service to address that problem from the customer's perspective. So one of the things I try to get my students to do is to understand the value from a target market, target user perspective, right? Because frankly, that's all that matters. If we don't know the who, if we don't know what their values are, if we don't know what their problem is, we can't analyze it from their perspective. And we can't tell the story from their perspective to let them know how this addresses their problem, solves it, creates the opportunity. So the next thing we talk about is this thing called worth. So we use these terms all the time in the business. What's something worth? What do you think it's worth? Right? The first thing we do with our students is we teach them to determine how much they can afford to pay for something. Right? How much is that worth? How much, from your perspective, given a number of different factors, can you afford to pay for it? So value of all goods and services from an economic standpoint is typically how we define worth. What does it do for me? So what does the word worth mean? It's a common term. We banty it around all the time, right? So what does it mean? Anybody? You answered correctly the first time. You're an economist? So don't feel bad. I ask people this all the time and they go, well, you know, it's what something's worth. I don't know, it's what somebody will pay for it, right? So that's a lot of times in our business, the answer, especially if you're a broker. Really doesn't matter what it's worth. I just care what he's willing to pay for it, right? That is the value. Don't confuse me with the facts. We say, so worth is it's a noun, right? It's the quality that renders something desirable, valuable, and useful. So we're back to this utility thing again, right? Usefulness. So worth has to do with its usefulness. Can you create value? We hear architects say this all the time. Any architects in a room? Anybody with an architecture background? Anybody work with architects? Okay, so I love when architects say this. And I'll tell you a really quick story about this, and I'll tell you why I think this is hoo-ha. I got a phone call one day from the dean, this is years ago, from the dean of the School of Design. And he said, listen, I have a lunch appointment I'm supposed to give a talk at today, and I can't make it. He had to go do something else. Would you mind going to do this for me? I'm like, yeah, sure, fine, whatever. What were you going to talk about? And he says, I'll send it over to you. I said, okay, great. Now, this is how long ago this was. All right. He had to fax it to me because we didn't have email. So he faxes it over to me, and I read his remarks, and I'm like, you know what? This is really a bunch of baloney. So I went to the lunch meeting, and I was introduced, and I got up, and I said, hi, I'm here. You know, I want to apologize on behalf of the dean. He's not able to make it. He asked me to come speak to you, blah, blah, blah. And he was going to talk to you about how architects create value. I said, he gave me his remarks, and I crumbled them up, and I threw them over to the side. And I said, but I'm here to tell you that's a bunch of bull, okay? Architects do not create value. They cannot create value. They also don't build things. I always love it when you read in a magazine an architect who built this building. Architects don't build buildings either. That's not my point. So the answer is no. They do not create value, all right? When we build a building, we actually don't create value either. When we develop something, we don't create value. What do you think we do? If I believe we don't create value, what do you think we do?
Create utility, usefulness.
Okay.
Worth.
What?
You create worth.
Create worth, which implies usefulness from somebody else's perspective, right? That value proposition. All we can do is capture value. The market determines the value, right? So what I try to get students to understand is what we do every day, right, is try to capture as much value that the market is willing to offer as possible. And you do that by trying to define whatever it is from their perspective in a way that it recognizes utility from their perspective. That's the value proposition, right? So all we can do is capture the greatest amount of value possible. But then I get people who will argue with me about this. And they'll go, yeah, but what do you get? Somebody will come along and pay some huge amount of money for something. So does that really set the value? Do you think? No, and I'll get to that in a minute, but go ahead.
But a Frank Gehry building creates more value than an architect off the street.
Only if people recognize that value, right? And only if that building is designed in such a way that it provides a utility for its users, for the community, right? For whoever it is who's going to use it. If you don't recognize the value because it's incredibly inefficient building, either from a use standpoint or from a operational standpoint, right? Or it's not really accepted because it's odd, right? And you find this a lot of times. Take example, one of the better examples, easier ones is take really, really expensive custom designed homes where somebody decides that they're going to put a bowling alley in the basement, and they're going to have some like weird movie theater thing with trapeze, and because to them that's really cool. They valued that. They're willing to spend money on it. It's really cool. Then you go market it, nobody wants it. Couldn't care less, right? In fact, it becomes a detriment, right? So it becomes something that takes away from the value. So, some of these things really have to do with how others see them. So there's a lot of theories of this idea of value, right? There's no single theory. There's a lot of different perspectives on this as well. So which one of these do you think is, you can read them, which one of these do you think is related to real estate?
Intrinsic.
Anybody else? He says intrinsic. Subjective. It's a subjective theory of value, most directly relates to real estate because our opinions, those things that we use to determine value from our perspective, are subjective. Right? Person believes that house was cool and beautiful and they're willing to spend a lot of money on it. Everybody else looking at it went, yeah, no, I don't think so. Couldn't care less. So go back to Frank Gehry building. Architect designs a building. They say great art is when 50% of the people love it and 50% of the people hate it, right? So what is it? Is it great? Is it controversial? Is that great? What is it you're trying to achieve with it? Becomes one of the questions to answer. So a couple of examples here. How many of you are familiar with this tulip mania? So so economists use this to, in common terms, to describe economic bubbles, right? So 1600s, trader comes back to Holland with a tulip bulb and tulip grows and people go, wow, this thing's amazing. I've never seen one of these before, right? And traders start bringing them back and people want them. They want them because they've never seen them before because they're unique and everybody wants them. And when a lot of people want something and you don't have a lot of them, what happens to the price? It goes up, right? So supply, demand. So demand high, supply low, prices for tulip bulbs go way up. And finally one day somebody goes, it's a flower, okay? And we can get lots of them. In fact, there seems to be a lot of them around. We can grow new ones, right? So this is like nuts. This really has no value to us at all, other than it does have some intrinsic value because we think they're beautiful, right? Market collapses. So this is one of those examples of supply and demand balance, imbalance. Need versus want. This is another big one that has to do with utility, has to do with supply, demand, and value. So need equals demand, which equals need. Need or want does not equal need. Just because I want it doesn't mean I need it. But want does equal demand. When you have need and want together, you get big demand, right? That's really, really what we're after. But want can be fleeting, whereas need is sustainable and durable. So we get things that go in and out of fashion, right? And some of it may be architecture, may be design, and things come back. Mid-century modern. People are jazzed about it now. 20 years ago, nobody really cared about it, right? So you have these resurgences. And these resurgences and these fashions that come and go help establish value. Great example, right? Need versus want. do we really need this? Okay, do we freak out when we get in the car to drive away and go, crap, I forgot my phone, okay? I gotta go get it. And it wasn't just the phone, now it's the fact that the phone does everything for us. So we've created this demand for something around something we really don't need, but it's become so useful to us. The utility factor is so high, right? We're willing to spend the money on it, we gotta have it. That will translate to real estate here in a minute.
Did the phone create or capture value?
It captured value, right? But there's this idea of unrecognized utility, unrecognized need, or unrecognized want. So, you know, when Henry Ford was asked about the car at first, he said, if I gave them what they wanted, they would have wanted a faster horse, because they didn't realize what this thing did for them. And once they realized it, once they recognized it, right, they said, wait a minute, that's a way better alternative. So it was a recognition of a utility that they didn't see because they had never had it. When this came out, right, it completely changed things. So stick with this for a minute. When was this first introduced into the market? When could you first buy it?
2006. This being a cell phone or that?
This iPhone. 2007, June of 2007. When was the App Store first opened? 2008, right? These things didn't exist at the beginning of the recession, right? So we've gone through this recession. These things have now completely altered how we think about what we do, how we do it, where we do it, and that changes demand. Changes demand in a lot of different ways. You see this reflected in the retail industry as an example. So you see utility factor for retail space completely changed because technology shifted things on us. So how do you evaluate that? So you've got a number of factors that influence supply, demand, influence value, worth, all of those other factors. So back to the story of the caveman. This is about utility and recognizing these things. So this is another one of these economic concepts and stories. Caveman, okay, in order to eat, has to kill the woolly mammoth, right? So the way that they do this is a whole bunch of them go out the beginning of the day, right? And they look for the woolly mammoth and they jump on its back with wooden spears and they stab the thing, right? In the process of doing that, a lot of them get killed, right? Not a really good way to do it. You really don't want to be on that party when they say, go out and get dinner for tonight. Then one day, they're perched on the edge of a overhang, waiting for the woolly mammoth to come by, and a guy knocks a rock over, and it hits the woolly mammoth and kills it right there, and they're like, that was cool, okay? Nobody died, we got dinner. They recognize the usefulness of a rock that had been in front of them the whole time, and it changes their entire perspective of what value is for that particular thing. And by changing that perspective and recognizing the value, they then figure out how to use it and use it differently. This happens a lot of times when we're looking at evaluating buildings from an adaptive reuse perspective, right? When we're looking at underutilized property, how do we evaluate alternatives? Right? We have to have this kind of mentality. The other economic concept which really describes subjective theory of value is the water-diamond paradox. This was first introduced by Adam Smith in the seminal, anybody read Adam Smith, Wealth of Nations? Cover to cover? Yeah, one of the most difficult things you can give somebody to read, right? But he first describes this scenario, and it's a good example of subjective theory. So I'm going to be a little sexist for a minute. How many women would love a 3-carat diamond ring if you were offered that 3-carat diamond ring? It's like, yeah, okay, that would be cool, all right, and I would show everybody. So now imagine you have that ring and you're off with your significant other person on a tour of the Sahara Desert, right? And your camel dies, right? And he goes, stay here, I'll go get help, but doesn't come back. One, you find him, you're going to beat him. But two, after several days, all right, in the Sahara Desert, you're this close to dying because you don't have water, and somebody wanders by, a sheep herder, and he sees you laying there that close to death, and he says, you look like you need help. I have water, would you like some? And you go, yes. Right? And he says, I'll tell you what, you give me that diamond ring, I'll give you this water. What are you going to do? You're giving the ring up, right? Every time. So the diamond has value to you only because you have a subjective view of it, right? It has no other utility whatsoever. Whereas water has incredible utility. We need it, can't live without it, right? But we don't value it nearly as highly. And why is that? Two things, supply, demand. If you live in a third world country where you have to trudge a mile to go get water, only to find that that water is not clean anyway, the value of that water goes way up. So things have value based upon your own perspective of them. So real estate is thought to have value from a subjective perspective, right? Theory holds that one can capture value simply by transferring ownership from one person to another. So you're a broker, this is your best day, right? Because you transfer ownership, when that happens, you get paid, right? If there's no transfer, there's no value exchange, you don't get paid. So you can only recognize value in exchange. And that's really what this is about establishing a perspective of the value of something from someone else's perspective so that you can get them to exchange the title or the right to use it for money, right? That's the entire objective here, is establishing value in exchange. But value isn't a singular thing. Remember we said it's a matter of perspective? There's all sorts of different values that we deal with all the time in this business. Now, so this is a chart, this isn't even all of them, but there's probably another 5 or 6 I could think to put on here. But there's all sorts of values. And what's the difference between all of these? What makes each one of these different from the other one? Who said that? Perspective. Yeah, it's the perspective, right? Mortgage value, it's the value from the lender's perspective, right? Capitalized value, we talk about that all the time. But what drives capitalized value? Cap rates. Cap rates are a matter of somebody's perspective. We're going to talk more about that later, right? Book value, value in exchange, leased fee value. It's all a matter of perspective. Salvage value, prove value. So these are all different values. So market value. Let's talk about this thing called market value. I'm going to talk about it in terms of the winner's curse. Anybody ever hear of the winner's curse? You must be the economist. Winner's curse basically says in an open auction, or what they call common value auction, like you're buying a piece of artwork or something like that, the person who wins the bid, in theory, paid too much. They overbid, right? They overpaid for it. What would the market value be? Well, let's look at this very simple example. Let's assume that you were taking bids on a house, okay? It's a really tight market, right? And if you had a house in this price range today, you'd probably get this many offers on it within several days, okay? So let's assume you say, okay, best and finals, I want offers from people. And you get this range. Well, who are you going to sell it to? 192,000, right? The guy, the person who offers that. What's the real market value? 157,333, which happens to be the median of all of those bids, right? That's what the market really valued that as. The guy who paid 192,000, in theory, overpaid for it. So we do have to be careful when we talk about market value, and that's one of the things appraisers are supposed to do, is account for these kinds of factors when they're looking at the value of property by making adjustments, right? So how do we estimate value? We've kind of talked about what it is, we've talked about the issues with it. How do we estimate it usually? Comps are what? Market values, right? So you can pick one or two comps. You gonna get it right? Yeah, exactly. You know, move your thumb around and you're hoping. I'm guessing this is right. So typically we turn around and look at an appraisal, right? We go, okay, so let's get some idea of value here. So we're gonna get an appraisal. What's the operative word here? Opinion. Right, an opinion of value, right? They use three approaches: income approach, comparable approach, and the cost approach, right? Everybody's familiar with all those things, right? We use this stuff all the time. How many of you ever gotten an appraisal back and you go like, really? You're delusional. How did you derive that value? I know it's an opinion, but you got a really lousy opinion, okay? So then you got to go get another appraisal. I just had this done, by the way. You have to go get another appraisal, right? And so then you sit and you spend time with them because you want them to pick the right comps. You want to make sure they have the right set of what? Assumptions. You want to make sure they have the right set of assumptions about this thing, because it's those assumptions that are going to form his opinion. So defines supposedly the highest and best use first. They can't give you an opinion of value until they've defined the highest and best use. That's a big part of the whole market analysis in looking at the property itself. So in order to determine fair market value, you've got to be able to determine highest and best use. Highest and best use is defined as that use of vacant land which is legally permissible, physically possible, financially feasible, and maximally productive, right? So a couple things that make it tougher for appraisers to figure some of this stuff out, they get wrong a lot of times, isn't necessarily the legally permissible one, right? That's entitlements, zoning, we can look at that kind of stuff, although they get that wrong too. They kind of get the financially feasible part kind of right. Appraisers are terrible at doing discounted cash flow analysis. They're not really the best at doing that, especially if you're looking at raw land. Income property, okay. Raw land, not always the best, right? And there's two things that they have trouble with a lot of times, and that is the physically possible thing and the maximally productive thing. And those are the two things that define capacity and utility of the property, right? And they're the two that are the hardest for them to figure out because they're design related, right? And that means you got to sit down and spend the time to do it. So what they're trying to determine is fair market value, and this is the legal definition of fair market value that's found in the Internal Revenue Code, right? So fair market value is a term that we use when we talk about value, and that term is actually legally defined. How many of you know this definition? You should, right? You should know this definition if you're in this business because it is a legal definition. The key parts of this are the price at which property would change hands between willing buyer and seller, neither being under any compulsion to buy or sell, and both having reasonable knowledge of the relevant facts. You can't determine that when you simply look at market comps, right? It's hard to tell what they really knew. But you didn't know what their level of expertise is, how ignorant they are, how much they really knew about the property, et cetera. So appraisers look at this in terms of replacement value, right? They look at it in terms of market value, which we talked about. They talk about it in terms of residual value, right? Something we use a lot of times. Residual value is the value that we use most often. It's the value that I focus my students on learning how to determine, because it's the one that really looks at the productive capability of the property. And that's what you're trying to determine, is what's the productive capability of the property to determine what its maximum value is likely to be. So real estate is fixed, durable asset, makes it a weird asset, right? So the value is partially determined by its location as well. So we can determine physical capability, right? You build the same building on two separate pieces of property and they have totally different values. Why is that? Location. And why is location the critical factor there? What's that?
Desirability.
So, yeah, it has to do with locational attributes relative to users' perspective on the property. So if you're a retail user, right, and you're off the corner and you're around back, right, you generally in a well-located place, but you're more specifically in a really lousy place, right, you're not going to be able to stay in business. You can't stay in business, right? You're not going to be able to pay the rent. You can't pay the rent, the value of that space goes down. In fact, it may be de minimis or worthless. Hotels, right? Certain things have significant locational attributes that they rely on, right? So location becomes critically important. Some uses not so much, like single-family residential. Relative location may not be as important. Industrial facilities, proximity to transit, rail, things of that nature become a big deal. Then you've got other characteristics because you've got obsolescence that gets factored into this. So differences in location are reflected in price disparity between particular locations. So what we see this represented as, how much will somebody pay in rent? How much will they pay for the property? And those things affect the ultimate land value. So what we're really trying to do at the end of the day in this business is determine value from a perspective in order to establish equity. We're trying to understand the amount of equity that we can derive from a piece of property. So equity is everything that's left over. The objective is to increase owner's equity. So what's the legal requirement of management? There's a legal requirement. If I'm the managing member of a limited liability company, if I'm the president or an officer of a corporation, what's my objective? I have a fiduciary responsibility to do what? Increase shareholder equity. That's the entire game. That's what we're held to, right? We have a fiduciary responsibility to do that. We fail to do it, what can happen to us? Get sued, breach of fiduciary responsibility, right? So equity is the name of the game. That's what we're trying to do. If we want that value in exchange, right, we want the exchange to be such that we've optimized the amount of equity that comes out of that piece of property. So in business accounting, owner's equity is all the interest in the assets less all of the liabilities. Basic accounting formula. In real estate, equity is the difference between what the market price is, fair market value, right, and all of the liabilities associated with it, any debt that you have. So equity equals value, value equals worth, worth equals money. So everything that we do is an expression of value in terms of money. Right? So what we start doing to communicate in numbers, to tell the story in number, is start deriving these numbers down to look at money. And how do we express these things in terms of money so we can determine worth? So what is money? Okay, functions as a means of exchange. It's a store of value. It has a number of other functions that are important to us. But everything that we do, we express value in terms of money, right? An asset's an economic resource, and this is the important word, as a result of past transactions, right, or events which have future benefits. So past transactions, future benefits. You buy something today, right? What you're looking for is that value in the future. It really doesn't matter what it is today, it's what it's going to be in the future. So what's the opposite of an asset? It's a liability, right? Or a contingent liability, which is something that might happen. So what's the effects of liabilities? The effect of liabilities is it reduces equity. Reduces equity because you subtract it from the asset value. Basic accounting formula. So one of the things I try to do with this with my students is I get them to think of their pro forma in these terms. So that when you're creating that story you're going to tell in numbers, you're doing it around this basic concept. Because this allows us to begin thinking about financially engineering something. So we can estimate a fair market value, which is what we can define as the asset value, right? And then we can figure out all of the liabilities. And we can see the effect that those have on the equity itself. And we can work this in reverse or forwards to look at how you analyze an opportunity or an existing asset. So another perspective, equity is positive, debt is negative, right? These are my sayings. Equity is soft, debt is hard. Equity is forgiving, right? Debt is insistent. Equity is a pillow, debt is a sword. What do you want to fall on? You want to fall on that pillow, right? You don't want to fall on the sword. Right? So this is another way I get them to think about this, because we develop a mentality about, let's go get a loan. Okay, we get a loan, okay, we're going to do this, we're going to do that. What's the risk of borrowing? We use debt as leverage. We use leverage to raise our returns, right? But what's the risk of debt? The effects of leverage is it increases potential gains, right? But it also increases potential losses because the risk of borrowing is the risk of repayment. We all learned that during the recession for sure, right? So it increases the potential loss because of the risk of repayment. That's a risk that we have to account for. Increased risk may still lead you to want to borrow. But how do we begin to reflect that increased risk? It's not just a matter of saying, I can borrow, and because I can borrow, I can get higher returns, and therefore, I'm good. I should do this, right? So the risk is the risk of payoff. Lower debt, lower risk, lower to mid-range returns that you're going to require. If you're going to borrow, you have a higher risk profile, means you're going to have to command higher returns. Talk about the use of debt in terms of leverage. And what are the things it does, the things it do for you? It allows you to buy more, right? It allows you to use your cash more effectively, the equity that you have. It allows you to spread risks, right? So it's an important tool for us to use, right? And we call the use of that in terms of our portfolio, in our business decision making, in terms of financial engineering. But common mistakes, markets always go up. You know, that's not the case, right? Leverage always increases my returns, ergo, I should always borrow money. So when we begin thinking of it in these terms, what we begin defining are hurdle rates. One of those measures of merit that we'll use to analyze an opportunity based upon the financial engineering that we're going to create in order to buy something, own something, whatever it is we're going to do with it. Right? So that interest rate on the borrowing is a basic hurdle rate. If you're a corporation, your cost of capital is your rate of return that you have to analyze all opportunities based on. So opinion of value is merely the result of a lot of assumptions about the future. Right? This is now getting us into this discussion about what risk is, how we apply risk to financial analysis, how it's reflected in the basic metrics that we use. So when we're doing this analysis, we're not just analyzing it today. We can collect all the facts on an existing property today, but it's not today that we're interested in. It's the future, right? So what we're doing is we're deriving an opinion about the future potential value. So financial analysis is simply assessing possibility of future benefits from current actions, right? We're going to make an investment today in hopes that it's going to do something for us in the future. What that something is, we don't exactly know, but we're betting that it's going to be whatever that analysis tells us it's going to be. So what do we know about the future? We don't, right? So we can't predict it, right? So we're making assumptions today about something that hasn't yet happened, and we're making those assumptions in order to make a business decision. And the problem is that's risky. That's a risky proposition. So how do we bake that risky proposition into our analysis so we can make a better decision? Risk is the probability of something happening or not happening. Two types of risk, systemic and unsystemic risk. Systemic risk are those things that we got no control over. It affects everybody, right? So oil prices to us, right? What happens in China, hurricanes, tornadoes, terrorist attacks, all those things affect the future or affect us currently that we couldn't predict before. Unsystemic risks are specific risks. And unsystemic risks for real estate may be changing market conditions because you have an evolving marketplace, right? It may be physical obsolescence of a piece of property. It may be characteristics of the neighborhood. It may be the fact that ADOT decided to build a new freeway and it affects my particular piece of property directly. So those are unsystemic risks. A lot of those are much more predictable. These systemic risks are much more difficult to predict. So I talked about this obsolescence, relevancy, and urban dynamics. So one of the other things that makes real estate interesting and difficult to predict is the fact that it is fixed, it is durable, it gains its value partially from its location, and that location is always changing relative to everything else around it. So how do you predict that? If the value is derived from location and that location delivers value because of the characteristics and those characteristics change, neighborhood life cycles, transportation patterns, right? Design styles, right? Things that change in the marketplace affect us. So how do we deal with all that uncertainty in our analysis? What's that?
Adjust your returns to reflect that, so lower the value or increase your necessary return?
Increase your necessary returns, right? This idea of risk-related returns. Higher the risk, the higher the return you're going to need to get in order to warrant taking the risk. So we do this by looking at scenarios, contingencies. We don't know what the future is. I can't predict it. So all I can do is try to model it some way and change all of the key factors to see what happens to me. I want to see what happens to my asset value relative to my proposed debt levels, to see what happens to my equity. So my required rate of return changes. How do you determine an appropriate rate of return? How do we determine rates of return? Yank out a number? What's that?
Perform.
Say again? Estimate risk. Okay, so it's relative, right? It's relative to other opportunities you have, right? What else? It's a bunch of factors, right? So to tell the story of risk and returns, we looked at this thing called capital asset pricing models. So we deal with this stuff in the real estate business. It actually comes from corporate finance. We've applied it to real estate. So this thing called capital asset pricing models is the thing that we use today unknowingly to most people, right? So capital asset pricing model looks at several factors in order to determine a rate of return. So it's a buildup of factors. It's not a single thing. It's several. It's the risk-free rate. So that's what you're talking about, right? So my savings account, treasuries, right? So we look typically in this business, we go, okay, so what are treasuries at, right? Because that's my safe investment vehicle. So I know what I can get from that. But then we have to add this thing called the risk premium, right? The beta. And the risk premium is, boy, how certain or uncertain am I? What is the probability of systemic risks affecting the performance or utility of this piece of property? Okay? What are the unsystemic risks that I got no control over, I can't fix, right? I got nothing I can do with it, right? So I got to determine a risk premium. And then I look at the expected market returns. What's everybody else getting? What could I take my money and go buy something else similar to this, and what kind of return would I get? Right? So I take all those factors and I put them together, I build them up, and I get a single number, my rate of return. 18%, 22%, 35%, 4%, whatever it is. Right? That's where it's supposedly coming from. So it's the rate of required return is actually the buildup of these several factors. We have a tendency a lot of times to just yank it out of Price Waterhouse, Cooper's, Corpex investment survey that comes out every quarter. Right? We go, what's everybody else getting for the same stuff? Without really looking at what all the factors are. So we see this reflected in a couple of metrics, our capitalization rate and our discount rate. Right? So we're analyzing these assets, right? We're beginning to tell the story of this piece of property through numbers. We're collecting information, which we're then going to add into this story, right? And then we've got to evaluate it. We evaluate it in order to determine whether in fact it's desirable to us. So we use capitalization rates, we use discount rates. What's the difference between these two? We use a bunch of others too. What's the difference between a capitalization rate and a discount rate? How many of you use discount rates on a daily basis? How many of you know what a discount rate is? A couple of you?
Discount rate over a longer period of time. Often the cap rates are.
What's that? Get to a net present value. Is it over a long period of time? Were you going to say something?
I was just going to say to adjust for the time value of money.
Okay, so capitalization rate, which is what is often used to determine the value of something today, right, is a single point in time. That's all it is. It's a relative measure compared to everything else that may be available in the market. Single point in time. That's your cap rate, right? Discount rate is the rate at which you discount future cash flows to the present value, accounting for all of those other factors we were talking about before, right? Safe rate, risk premium, market rate, those kinds of things, right?
Say that one more time.
So the discount rate is the rate at which you discount future cash flows to the present value, right? And it is a buildup of all of those factors we were talking about. So, two types of analysis. Analysis of what is and the analysis of what could be, right? The analysis of what is what we call ex post, right? That's when you have an existing income producing asset as an example, and I can look at the rent rolls, I can look at the operating statements, right? And I can evaluate it. I know it. I got the stuff. I've got all of the invoices for all of the work done. I've got all the utility bills. I got all the management contracts. I know what the rents are, right? I can look at it and know what it is. That's way easier to do. The analysis of what could be is what we call ex ante, and that's way harder to do. Because if you make the assumption today about value using a cap rate for an existing income property, all you've done is look at it relative to that return requirement today. It has nothing to do with the future. So to take that discount rate and assume that that will give you the value from an investment perspective is way wrong. That's a big guess on your part, right? It's a big bet that's got a lot of risk to it, right? So we've got to use other methods to analyze the what could be thing, right? That's where we get into the interesting financial analysis stuff. Analyzing the existing, not so interesting, right? Pretty simple. Argus is fabulous for that, right? Argus is not so fabulous for the what could be thing. So how do we assess value? We have to establish first these sets of financial measures. Right? These financial measures are what? They're a matter of perspective. Right? They're a matter of perspective. They reflect a set of values, objectives, goals, limitations that we have. Our own cost of capital, our own alternative investment requirements, a whole bunch of other things that are different from one person to the other, from one company to another. Right? So there's not a single categorical answer to rates of return. You really have to spend the time to think about them. And it requires some analysis up front in order to assess that risk premium, that beta, that we want to apply to this thing. So cap rate is based on a single year NOI. Discount rate is used to calculate the present value of future cash flows, right? Cap rate simply values something today, single point in time, right? So it's a static value analysis. V equals I over R. So value equals income divided by rate. Everybody familiar with that formula? Okay, very simple. The other thing we use to determine static value is a basic residual land value calculation, right? And that's a little more complicated, right? So residual value equals project value minus cost to create plus a reasonable profit, right? Important thing here is that right there, reasonable profit. Right? Some of these other things may be a little bit easier to calculate, but then you got to figure out how much profit should I make on this thing? And how much profit I need to make on it has to do with what?
Risk.
Has to do with the amount of risk, right? The risk associated with making a guess that you will be right when you make this analysis and project the future. So, whereas cap rates are static, what we're really interested in analyzing the what could be, right, is what's known as yield capitalization rates, right? We reflect that in terms of this thing called internal rate of return. It's just like a cap rate in some regards. However, it looks at time. It includes returns over time. So yield capitalization, right, is the measure that's a better indicator of the likely value of something and the exchange value in the future. Because that's what we're trying to figure out, is exchange value in the future. Discount rate, okay, is many times the required rate of return, okay, or the institutional investor's weighted cost of capital to bring money back to today. I'm going to talk more about these in the next session. But internal rate of return and discount rates are what we call kissing cousins, right? So you know why? The related elements. You know why that is? Because the internal rate of return is the discount rate at which the net present value of future cash flows will equal 0. Right? So the internal rate of return is that hurdle rate that I was talking about before that we're going to use to evaluate the future. And we have to think about it in terms of dollars today, not dollars in the future, because a dollar in the future is worth less to us. So we have to discount that dollar in the future to today and evaluate the opportunity based upon that. And so we match up internal rates of return and discount rates to consider present value so I can make a decision today about future opportunities. That's what this is all about. So the return on an individual asset should, at a minimum, okay, equal your cost of capital. Right? So if you've got a cost of capital of 10%, right, you want something to return to you at least that 10%. The key is selecting the required risk premium to add on to this thing. That's the hard part. That's the intuitive part. That's the ability to maybe predict the future, to understand systemic and unsystemic risks, right? That's an understanding of what all other alternatives you have may be. The only reason an investor would accept a riskier project is because they can make a higher return sufficient to warrant the risk itself, right? So why are investors paying such low cap rates on core plus apartments in Phoenix? Perception of risk, right? Plus, there are alternatives. Cost of capital is so bloody low. They got to put money to work. It's a hard asset. There's a whole bunch of other things that get baked into their calculation to determine returns, right?
Why is the minimum return equal to the cost of capital? Shouldn't it be just at minimum slightly higher?
So what I'm saying is it should at least be. So if you're looking at capital asset price, if I'm a company, right, and I'm looking at buying a piece of equipment or expanding a facility, adding on to it, right, and I go to the CFO's office, that CFO is going to look at their weighted cost of capital, and that's what he's going to use. That's all he's looking at. He's not looking at a profit. He's looking at weighted cost of capital. Real estate's a different ballgame. But if I'm out talking to State Farm, right, about buying a piece of property or Amazon building a warehouse, that's a different mentality than it is if I'm out as a speculative investor developer building that warehouse. Okay? So I say, at a minimum, you got to at least get your return, your cost of capital back. That's like breaking even, right? I didn't lose anything. I got to at least get that. But then I got to add this risk premium on top of that to warrant the effort, the risk, right? The opportunity costs and all those other things. Does that make sense? Kind of?
Why would anyone do something that is directly equal to it?
You
Even if you are Amazon or a speculative investor.
Well, but that's exactly how they analyze those opportunities. You go to the CFO and he's going to go, my weighted cost of capital is this. Therefore, you, Mr. Plant Manager, got to get me at least this. And it's an increase in production capability, and that increase in production capability is going to produce this kind of revenue to us. So I at least got to get that.
Well, there's zero cash flow assets out there too.
Yeah, there are.
So, I mean, they're at a minimum, their return is the cost of their capital, but at the end of that debt service, they're left with an asset. So there's
Right.
residual value.
So there is a residual value there, right? So that's a different calculation. You're looking to the future and saying, hey, listen, I know I'm going to pay this, I'm going to make nothing, but when I'm done, I'm like the state land department or ASU, right? I'm not going to get very much on this land lease. I'm good with this, but at the end, I own all your buildings. Thank you very much, right? So the question is, what's the value of those buildings 65 years from now, right? And what does it do to the value of the land? So it becomes an interesting calculus because it may be worth nothing because of locational attributes, obsolescence, all sorts of things like that. Yes?
Why is cap rate used in real estate when, there's always debt? And you could be talking about a building that's 20% occupied and not IRR or something like that to describe its value.
So the cap rate is used really only to look at the relative value of something today compared to other opportunities that are in the market. That's how you should use it. Because it really doesn't tell you very much, except about this point in time. So that is the net operating income, right, divided by whatever return you want to place on it. The inverse is somebody bought something, I'm going to look at what their NOI was. I can tell you what they cap rate they bought it at.
Yeah, but you could say this industrial building is at a 2 cap, but it's 5% occupied in a strong market, and it doesn't really tell you much about the building.
No, I agree.
Yeah.
I don't put much weight on them at all, quite honestly.
Is it just because it's easy to calculate and IRR is hard?
Super easy to calculate, right?
You can compare it against stock.
You can compare it against other things, really simply. It's a back and napkin thing, right? So that's all you're really using it for. I don't put much weight on them. And yes, people have a hard time calculating IRR on their iPhone calculator, right? It's too tough to do. So scarcity of critical resources results in competition for their use. In finance, we compete for value, we compete for yield, right? So that's what we're competing for. One of the things that happens in the marketplace is, and one of the reasons why cap rates are low, there's a lot of money in the marketplace, right? There's been a huge amount of money in the marketplace seeking yield. And so that competition for yield drives values up because it's driving yields down because people are trying to place their money, right? So one of the other factors we have to look at is these other things that affect competition, and scarcity is one of those. If there's a scarcity of buildings, right? You only have so many core plus buildings, you only have something that's one of a kind, right? You're going to get demand for it. So if you have a house that is worth somewhere in $155,000 today, and you put it on the market, people are going to flood to it, right? Because there's not many of them. There's hardly any of them. So you'll probably get more than that listing price, because that's happening all the time today. Same kinds of things. So there's a lot of other factors that affect value, affect people's decision making, affect the metrics that they use, right? So it's not a straightforward thing. So back to this telling numbers, telling stories with numbers. how do we organize the story? So we've kind of talked about these things. We've talked about metrics. We've talked about perspectives. We've talked about those things. So how do we organize this story? We're going to tell the story. What do? We organize it in terms of in what form? Pro forma, right? So we organize this stuff in this thing called a pro forma. The only thing pro forma means is to form, right? So we have this standard approach to analyzing things called the pro forma. It's the organizational format used for telling the story in numbers. So I'm going to end here, and I'll talk a little bit about the things we'll talk about in May. But some final thoughts. So is the saying, you don't get paid for the hour you work, you get paid for the value you brought to that hour, right? With real estate, you don't get paid for the real estate, you get paid for how useful that real estate was or is to somebody else. And that's really what we're trying to analyze. Next session, we'll talk about measures of merit, rates of return, return on assets, net present value, internal rates of return, cash on cash, cash multiples. We'll talk about financial analysis process, and we'll talk about the limitations of some of these metrics. So that was intended to give us this kind of big picture in a common dialogue so that when we start talking about the analysis part, we're all on the same page. Questions? Thoughts? Okay, hopefully that was interesting and useful.
Thank you.